AI's $750 billion capital crisis demands business leaders to build smarter capital returns and protect AI growth economics. You are facing an unprecedented operational shift as hyperscale tech enterprises deploy a staggering $750 billion in AI infrastructure in 2026, forcing a sudden transition from cash generation to heavy corporate debt issuance. If you think your enterprise is insulated from macroeconomic shocks, you need to look at the numbers. This massive expenditure marks a brutal 80% surge from the previous fiscal year, causing corporate liquidity reserves to deplete rapidly. Your borrowing landscape has fundamentally shifted now that Federal Reserve Chairman Kevin Warsh has hinted at interest rate hikes, pushing the benchmark 10-year U.S. Treasury yield toward a critical resistance level of 4.45%. In past fiscal cycles, you could rely on the tech sector's massive security cushion of over $300 billion in highly liquid cash equivalents, but nearly all of that accumulated reserve is currently being redirected into fixed physical assets. L-Impact Solutions emphasizes that your traditional equity valuation models are heavily vulnerable to front-loaded infrastructure costs, as a single state-of-the-art data center facility now demands upwards of a $1.5 billion initial capital commitment. You are exposed to serious refinancing risks and cash flow deficits by backing long-term capital assets with high long-term fixed coupon rates, while the 10-year yield hovers around 4.45%. To survive this landscape, you must lock in favorable borrowing terms ahead of impending Fed rate hikes by implementing advanced interest rate hedging programs via derivatives like interest rate swaps and swaptions. You can drastically stabilize your escalating utility expenditures and protect your operating margins by establishing long-term power purchase agreements with renewable energy providers spanning 10 to 15 years. Your financial planning teams must perform dynamic, regular stress testing of your current capital structures to simulate how your business handles prolonged scenarios where the 10-year Treasury yield climbs past 5% or 6%. Ultimately, L-Impact Solutions reminds us that true market leadership belongs to the firms that secure the highest return on invested capital through rigorous financial governance, rather than those blindly chasing the largest hardware footprint. Can $750 billion in AI spending deliver returns before debt wins? Comment below. For the full strategic analysis, visit our business consultancy link in the description below. Thank you.